Hello everyone, my name is Mercedes Lanier. I am a Pennsylvania real estate agent, and we all put on this event to give information in reference to investing and first-time home buying. Right now, we're for a couple things, and we'll be with you shortly.
How's everybody doing? Good? We awake this morning? Feeling good? You stretching a little bit? Bad for anybody? Joe already asked this question once. We got some more people in the room. Who is here strictly, you're looking to start investing and start getting into the investment space right now? And who in here is looking to purchase primary residences? So everybody's looking to invest. So this next portion may be a little bit boring to you because I'm really just going to get into the primary residence piece as far as buying as a first-time home buyer, buying as an individual, not an entity. First-time home ownership. Does everybody in here own a home? Own a home? Not primary. Okay. Do you guys plan on buying primaries?
At some point.
All right. So it won't be as boring to you. So I like to start off with the home ownership piece as far as when we're looking at first-time home buyers, we are looking for them to be established financially. Kind of the same situation, with investment lending and everything like that. They want to see that you have a decent credit score, that you have income coming in. Again, contrary to what Joe was just talking about, they can go off of the debt service of the property. We're strictly looking at what you as the individual is for your finances. So the first piece of that is going to be your credit score. They want to see that you have a 24-month history of established credit. Now, some people only have 12 months. That's completely fine, but they're going to do a complete 24-month look back as far as your credit is concerned. Most programs they have for primary residences are the minimum credit score is going to be a 580. That is for FHA, which is the Federal Housing Administration, the Veterans Administration, as far as my VA loans. Do we have any vets in the room? Thank you so much for your service. VAs, the Veteran Administration loans, they'll take credit score down to a 580. And the conventional loans, they have a minimum credit score of 620, but you really don't want to get into the conventional space unless you have maybe like a 660 credit score or better, because the interest rates are better. I'll get into that a little bit later. And then USDA loans, you want to have a minimum credit score of 640. How do we establish credit? So most people, if you don't have any credit right now, you have to kind of do it on your own as far as opening up secure credit cards or signing on to, if you have a family member or somebody like that, it will authorize you to be on one of their credit cards as an authorized user to get their credit history so you can start getting credit card offers. I don't recommend people opening credit cards and things of that nature to go into debt. So what I recommend when you open those secure credit cards, because again, you want to establish a history of credit. You open those cards up, everybody has a cell phone bill, everybody has a cable bill. You put both of those bills that you pay on time every month on those credit cards and you don't use them at all. And the reason why I say that again, because you don't want to go into debt and have more things going on to your credit score and give yourself the likelihood of, again, going into default on a card or missing a payment. You want to use that card for things that you pay on time already. Get cards with rewards if you can, when you start getting more established, because you want to get that cash back. But really, again, you want to have 3 strong credit references on your credit report. So open up 2 secure cards, like I said, $500 a piece on each of the cards. Pay something that you pay on time already and leave the card alone. Unless you're really diligent and disciplined with your money, you can use it on groceries and things of that nature. But like I said, if you're just starting out, use it on things that are basic. And then a healthy credit score, they say it has a good credit mix. So credit mix, when you're looking at a credit report, when I'm looking at a credit report, I see revolving debt, I see installment loans, I see student loans. If you have student loans that you have from college and stuff like that, and they are in deferment, those are helping build your credit score. You're a step ahead of everybody else, but still opening those 2 revolving lines are still going to help you, because again, they want to see your credit mix on your credit report. If you have a car loan, that's all well and good. But until you get to at least the 640 mark, you want to at least have, again, 3 credit references that are positively reported for you building that credit score every month. Next thing that we look at as far as first-time home ownership, we're going to look at a 2-year employment history. And that is from the date of your application back, 2 years from that point. So 2-year work history means that you've been continuously working without any gaps for 2 years. Now, are there instances where you can get approved for a loan when you had a work gap? Absolutely. So everybody knows we are experiencing a pandemic. So COVID happened. A lot of people got laid off from work. A lot of people got furloughed. That's completely fine. If you've been out of work because of COVID, once you get back to work and you've established yourself financially and you're back in that job and you're at least making the same amount of money or better, you need to be back to work at least 6 months before you can be approved for a residential loan at that point. If it's an FHA loan. Conventional loans, it will give you a little more leeway, simply because of the fact that once they see that you're established, and if your employer can provide a letter saying, hey, I'm back to work, and this because this, what's your name, sir? If Odell is back to work, he's guaranteed 40 hours a week at X, Y, and Z rate. We'll say, all right, great. He's back to work, he's full time. They'll lend you a house on that. If you've been out of work for a year and you've been on just unemployment, you haven't gone back to work, we're going to need to see that you're back to work for 6 months in that same field. Otherwise, so if you had a traumatic event, like I said, COVID, you had a child and you took some time off for that, that's completely fine. But if you've just been out of work for an extended period of time, anything over 3 to 4 months, they're going to want to see you back to work for 6 months in that field that you were working in prior to. Any questions on that?
Yes. What if instead of going back to that same employer, you go to another employer and you get a contingency off of letter from them? Can you still use that as a proof of income?
Absolutely. So if you go back to work to that same employer, to a different employer, but you have a letter, employment from the next people, as long as you're back to work for 6 months with them, then you can most definitely purchase that at that point. Any shorter period of time than that, like I said, FHA, the Federal Housing Administration, is going to be a lesser amount of time, a longer period of time. Conventional loans are going to have a lesser amount of time that you'll have to establish. What was your question?
If you got hurt, went on workers' comp.
If you were out of work and you were on workers' comp, they are going to ask to see all your documentation on that, and they're going to ask to see that you are back in good standing. Again, they're not going to ask to see your medical records or anything like that. But if you're back to work and you had again an extended period, but it was just because you were hurt, we will lend on that.
If you decide, I'm not going back to that job just for the burgers. You want to get, go into the real estate business and don't even go back to the garbage from the beginning. How can that work?
So,
even with new business, starting new business.
So if you're starting a new business, that's going to be a little bit more tricky because again, real estate agents are considered independent contractors. So you're going from being a W-2 employee to being self-employed. Self-employed, if we're self-employed folks in this room, we're going to need to see 2 years worth of tax returns from you to gauge what your income is. So when you become a self-employed earner, it changes the whole realm of time that you'll need to gain. You'll need to get 2 year history of being a self-employed earner.
Within that 2 years, you have workers' comp, you went to business, and then you generated income, what have you. It's case by case basis.
It is definitely case by case. You really need to see what time, when you went off on court workers' comp, when you were disabled, what time, when did you go to real estate school? Because if you're in college or something like that, or if you go to real estate school, if you go out and you get an actual, a certificate of completion from somewhere, they'll consider that gap when you were in school as work history.
From an investor standpoint, not to become an investor.
Okay.
Purchase property or flip or do something and not have to go back to the goofy stuff.
Exactly. So again, from your standpoint, you would probably just need to get at least a year's worth of time as an investor underneath your belt. And the reason why I say that is we have what is called a bank statement loan. Bank statement loans go strictly off of your deposits. So we do 12 or 24-month bank statement loans, and with that, then we don't need to see your tax returns or anything like that. Strictly off of your deposits that are going into your bank account, and we'll be able to lend to you based off of that. Has a little bit of a higher down payment, it's anywhere from 15 to 20% for the down payment on that. But again, it will allow you to purchase a property as a primary with a bank statement if you're just a new investor.
What was the minimum bank statement amount?
Minimum loan amount on bank statements are $100,000.
I mean, what they have to see in the bank for the bank statement?
Well, it really all depends on the type of properties you're looking to buy. So we're not looking for, again, as far as a specific amount as far as what you make or anything like that. They're going to take those deposits for over 12 months and they're going to divide them over the 12 months and we're going to use that as your monthly income.
So if I have a bank statement of, give me a number, 100,000 in bank or whatever, use that.
Okay, so that's a little bit of a different. That's an asset qualifier loan that you're speaking of. So asset qualifiers work a little bit different. They're going to use the depreciation of the money that's just going into that bank account. So if you have 100,000, we're going to say, all right, well, if we divide this over the next 3 years, because we have to have a 3-year contingency on primary lending. So they need to see that income's going to continue for at least 3 years. So they're going to average that out and say, all right, well, he's got 100,000. That's not going to last him X, Y, and Z. So they'll approve you, but your amount's going to be super small. But again, bank statements a little more. It's different. So if you have $100,000 worth of deposits for a year, they're going to take that $100,000 worth of deposits for the year, divide it by 12, and then they're going to use that as your monthly income to qualify you for the loan. So you can buy a $200,000-$300,000 house based off of that. Because they're using that money versus the debts that are on your credit report.
I like that.
Okay. That's the other thing. When we're looking at primary residence and primary lending and everything like that, your debts that we look at are strictly off of the credit report. So I really preach budgeting for first-time home buyers. You don't want to go house broke. You don't want to go house poor. So you really need to take account of all of the things that you have to pay on a monthly basis: your light bill, your water bill, your phone, your car note. The mortgage company, all we care about is what's on the credit report. So if you have 2 credit cards that are $25 as minimum payment, that's all we're looking at. But if your light bill is $500, we don't know that. If your cable bill is $600, we don't know that, and we don't care about it. Again, that's just us from a financial standpoint. We just look at the primary things that are on the credit report. So you just have to be prepared yourself and know, all right, well, I've got another $1,100 worth of bills outside of what this mortgage is going to cost me. Can I afford a $2,000 mortgage? Can I afford a $3,000 mortgage? Because you want to make sure that at the end of the day, you can go ahead and pay all of your bills and then you don't fall into default and go into foreclosure on your property.
Is your company a broker or you just have one deal in one company?
I'm sorry, I didn't even, again, I work for Cross Country Mortgage. We are a broker. We broker out to several different outlets. So we have a lot of flexibility as far as what we can do for borrowers in the primary space and investment. Again, Joe's a great resource for investment properties and things of that nature. But we really have a strong portfolio for people that are looking to buy for the first time. If you have a special situation like you're becoming an investor.
Do you do lending to people who are doing like investment properties as their first time? As a first-time buyer, so it's like, say you get like a multi-unit and it has like 2 to 3 units, and they intend on staying in one of those units, does that still count?
Absolutely. So we do lending for people that are looking to buy as a primary and live in that property as well. So for instance, you heard Joe talk earlier about house hacking. So house hacking people do when they buy a primary residence that's a multifamily, 1 to 4 unit. They decide that they're going to live in one of those units of that property. So the bonus to house hacking is with an FHA loan, you can put 3.5% down on a 4-unit property. So you put the 3.5% down, you live in one of those units for a year, and you can rent the rest of those units out. After that year is up, you can go and buy another residence for yourself and use the income from that primary residence that you bought to qualify for your next property. So
how much did you say you put down for that FHA loan for the month?
FHA is 3.5%. Yep, and that's down to a 5-year credit score.
Also relating with FHA loans, or if you were trying to do something with multi, is that a multi-unit?
Multifamily.
Multi-family. In that scenario, would that also require a longer than 2-year work experience?
would just need a 2-year work history. Yep, just a standard 2-year work history without any gaps. Like I said, unless you had a special situation where you were out of work, due to, COVID, you were back in work full time, you were in school, things of that nature. And if you happen to lose your job or something like that, and you're out of work for 3 months, we're not going to ding you for that. We're just going to ask for a letter of explanation why we're out of work for this period of time. I was out of work because I lost my job or I left my job, but I'm back full time and I work here. No problems there at all. Any other questions? Question. Okay. So we talked about credit. We talked about work history. So, like I said, for W-2 borrowers, we're looking for a 2-year employment history. We will need copies of your W-2s, 30 days worth of pay stubs, and 2 months worth of bank statements. Self-employed borrowers, we're going to need 2 years worth of tax returns. If you own your business for over 5 years, we will only need 1 year worth of tax returns that we're going to need to look back on. And then,
Can you buy a first-time home under your business name?
under your business name, you couldn't be considered a first-time home buyer because a first-time home buyer isn't an entity. It's going to the programs that they have out there are for individual people. So you wouldn't be able to purchase it under your business name. You could transfer it after you purchased it, but you can't do it initially if you're looking to get into one of the first-time home buyer like down payment assistance programs.
How soon can you transfer it?
So there's a seasoning requirement. You're going to have to refinance that property out to, again, your entity at that point. So
I have a property.
mhm,
I want to see if I can refinance it out to underneath my business,
mhm.
but still, can I do that?
You can definitely do that. Now, for us, we're going to need to see at least 7 months of seasoning. So from the date that you purchased it, you'll need to have 7 months under your belt that you had that property. I'm not sure what it'll be for Joe because Joe does a lot more work with
I had it
entities.
since 2010.
Oh, then you mean refinancing shouldn't be an issue for you. Again, they're going to look at the loan to value of the property and everything like that, but you shouldn't have an issue at all refinancing that to an entity.
And then I can go back and be another first-time home buyer.
So you can be considered a first-time home buyer after you haven't owned a property in your name in 3 years. So if you purchased a property in 2010, you sold a property in 2015, today you will be considered a first-time home buyer. But if you purchased a property in 2010 and you sold it in 2020, and say again this year you want to buy a property, you're not considered a first-time home buyer anymore. You would still need to be 3 years out from 2020 to be considered a first-time home buyer for a program. Okay.
Regarding the FHA loans, is there an application date for that?
You said application fee?
No date, is there a date for that, or you can apply for that now?
FHA loans again you can apply for whenever. They are one of the FHA, USDA, VA, conventional. They're all the standard type of loans. So you can apply for those loans whenever. There are different grant programs that they have out there that only come around at certain times of the year. So those grant programs, again, I don't have a list of them here today, but sometimes that's what you've probably heard before that, you can only apply for this, in January, February. That's when the money comes back to the program. Those are those type of programs. The standard programs, again, the FHA, VA, USDA are all government loan programs, so they're year round. Okay. Any other questions? Okay. So we talked about credit, we talked about your employment history, income. I don't talk a lot about income because we don't have an income requirement for just for purchasing a primary residence. But it is going to determine what your debt to income ratio is as far as qualifying for the loan programs. Debt to income ratio is how much money you make versus how much you owe monthly in your monthly obligations. Monthly obligations, I spoke about earlier, we're only going to look at the things that are on your credit report, including the new mortgage payment. So if you have 2 credit cards and a car note, we'll look at the payments on those, including the new mortgage payment, and then we'll divide that by your income and define what your debt to income ratio is. Each loan program has a different debt to income ratio standard. So for instance, the USDA won't take a debt to income ratio of 43%. FHA, we can go up to 55% on the FHA, so you can get a little bit more house on FHA than you can on USDA. It's really going to depend on what you qualify for. When we're looking at starting out to buy your first home, again, first step, like I said, is going to be to get the lending side of things. We're going to look and pre-qualify you, pre-approve you for a property. Your realtor, any of you guys have realtors? Okay. So your realtor is going to need a pre-approval letter from you when you're buying for the first time. They probably won't show you a property without it. So that's where, we come in as a lender. We're going to evaluate those things that I talked to you about, and then we are going to get that pre-approval letter over to your realtors there to help you guys shop and work on the process. Brain part, there we go. We talked about income, we talked about credit, and loan programs. So, as we talked about before, the FHA has a 3.5% down payment requirement, credit score down to 580. Now, they will take lower credit scores than that if you are willing to put 10% down on a property. So if you have a lower credit score, you have a great credit history, I won't say great, but you have at least established credit history, you can then purchase it with an FHA under 580. It is harder, and you will get dinged as far as interest rates are concerned. Interest rates are going to be much higher in that 500, 580 range. Getting above 600, 620 is definitely going to be the way to go as far as establishing your credit and purchasing with an FHA. There is mortgage insurance on FHA loans. There's upfront mortgage insurance that is financed into the loan balance, and there is a monthly mortgage insurance that does not come off of the FHA loans. It's one of the so-called downsides to an FHA loan that some people will tell you about. Because with an FHA loan, like I said, you can't get rid of that mortgage insurance unless you put 10% down on the property when you buy it, and then you can get rid of it in 11 years. Most people, again, don't put 10% down and use the 3.5%, and they are going to refinance out of that FHA loan once they reach 20% equity in the property. Now, it's got to be advantageous for you to refinance at that point. Because if at that point when you go to refinance, if the rates are in a good position and the amount of mortgage insurance that you're paying on that loan isn't enough to substantiate or make sense, you may want to hold off in doing so. Now, as Joe was saying, rates are pointing up right now. So if you are looking to buy for the first time, if you're looking to purchase for the first time, get all of your credit and things in order and purchase now, because rates are only going to go higher in the next coming years. You want to make sure you buy before then. So some people will say, well, you need to get your credit score up, don't buy with 580, get it to a 700 before you buy. I don't advocate doing that because you're going to do the same thing. If you buy at 580, yeah, you're going to have a higher credit score. You're going to have a higher interest rate. But if you wait till your score gets to 700, it takes you a year. A year, interest rates are at 6.8% or 7%. You did the same thing as buying with a 5-year credit score. Sometimes you do a little more detriment to yourself. So buy while you can. Build the equity, refinance it later. But I definitely recommend, if you're looking to buy, you don't have that perfect credit score right now. It's completely fine. You can still buy, today. VA loans. VA loans are awesome for our veterans. They have a 0% down payment, minimum 580 credit score. They really don't have a credit score requirement for VA loans, but most lenders are going to want to see at least a 580 with a decent credit history, no credit disputes, late payments, things of that nature. There is a VA funding fee that they have for veterans that they have to pay up front. Again, it can be financed in the loan balance as well. But that all these loans are insured by the government. So they want to make sure that they're getting some type of restitution for that loan, be it through mortgage insurance or be it through that VA funding fee. That's their kind of, hey, I'm going to give you this $400,000, but I want to get a little bit back because if you happen to default on this, I got a little bit of security that I got a little bit of my investment back.
That funding fee can be waived if you have at least 30% disability rating.
Absolutely. If you have 10% or more, you can waive it.
Okay.
Yep, if you have 10% or more, they will waive your VA funding fee. If you're a Purple Heart recipient, they'll waive your VA funding fee. So again, there's definitely ways to get rid of that if you are a veteran. And again, like I said, for the VA, they don't have mortgage insurance as well. So like with the FHA, you have to pay that mortgage insurance a month. VA loans do not carry mortgage insurance. And then you're only going to end up paying closing costs. Closing costs, on average, probably going to range anywhere from $6,000 to $8,000 on a USDA loan and VA, depending on the property itself. USDA, like I said, they will take into account everybody that is in your household. So if you're purchasing and you have income earners that are in your house and you are the only person on the loan, they're still going to look at the income of the other people that are in your house. So you have to keep that in mind as well. Because, yes, ma'am.
What if they're not moving into your house?
If they're not moving into your house, it don't matter. Yeah, if they plan to live in your house, they're going to look at that income that is coming up. They're going to see their tax returns and everything like that. If you pay for childcare, they'll take that into account and they'll add that to your income. And if you are disabled, they will take into account any disability costs into that as well and add it to your income to help offset it. And then there's conventional financing. Conventional financing is the type of financing most sellers like to see. And not because it's a better type of financing. They know that it has a higher credit score requirement. The buyers are a little more financially sound. Not what I see on a monthly basis. I have a lot of FHA buyers that are more financially sound than my conventional buyers. They have better spending habits, but again, the market stigma is that conventional is a better financing. 3% down is the minimum on conventional, to 5% depending on your credit score or credit rating. There is a private mortgage insurance, what most people hear is called PMI. PMI, you pay on that conventional loan until you get 20% equity in the property. If anybody's not familiar with equity just means how much your loan is versus how much your loan is versus how much the property is worth. So say a $100,000 loan, you owe $80,000 on it, house is worth $1,000, you've got $20,000 worth of equity in that property. So until you reach that 80% mark, again, you'll pay that mortgage insurance on the loan. You can, if it's prior to the point that it automatically falls off, because mortgage insurance will fall off a conventional loan at 78%, you can request it from the mortgage company to get dropped. Down payment assistance programs. So most of the down payment assistance programs in the state of Pennsylvania and the government's down payment assistance programs are going to require you to have at least a 660 credit score. The main one that we use for Pennsylvania is the PHFA. PHFA is going to, like I said, require you to have a 660 credit score. And one of the main programs that I use with them is called the KFIT program. KFIT program will give you 5% of your purchase price towards the down payment of your home. There are some requirements for that. Again, you're going to have the 660 credit score. You're going to have to show at least 2 months of reserves in your bank account. By reserve, I mean a month of a mortgage payment is called a reserve. So what I say, if your mortgage is going to be $3,000, we need to see 2 months of that in the bank account, showing that you have some skin in the game before they'll let you use the down payment assistance program. These programs for down payment assistance are repayable. So if you decide to sell that property within the first 10 years of living in that property, you do have to pay that money back. Otherwise, after the first 5 years, they will grant you amnesty on that and you will no longer have to repay. Any questions on down payment assistance on that one?
You said that they want the underlying program, the first one started.
Of the PHFA?
For the down payment assistance.
Yeah, down payment assistance through the PHFA. And like I said, the main use is the KFIT program. Now there is another program that we run through the government. It's called the Chinoa program. Chinoa will give you 3% or 5% of your purchase price through the government. You have to have at least a 640 credit score with that one. And that one is a repayable loan. So it will show up as a second on your mortgage going forward. So you'll have your regular mortgage payment, which is your principal, interest, taxes, and insurance, and then you will also have the repayment for that loan for 10 years. Now, yes, ma'am.
I was once told that you probably want to stick with the loans that you don't have to, the grants that you don't have to pay back for first time home buyers, as opposed to a loan like that.
So it's twofold. So I do recommend if you can get into a loan that is forgivable, I definitely recommend it. If you can avoid having it repayable, I definitely recommend it. But there's certain situations where people just don't have the funds or the financing to close on a property, and they need to get into a situation. That's when I would recommend like the Chanel program, where you have to repay, because again, they need that type of financing to get into their property.
So why not do sellers assist?
So seller's assist is a great tool, but it's not available all the time. Especially in the last 2 years in this market that we've been in, properties are going for over asking, and the sellers are, a lot of sellers haven't been willing to give money towards closing costs. Now, there's been a little bit of a shift in terms. I have seen a lot of it in the last couple of weeks.
I was about to say, it depends, I mean, it's about building relationships with that seller.
Yeah, for sure.
I mean, it's a strategy, and that's one of the things I'm interested in, why a lot of real estate, like individuals like you got yourselves, don't teach the art of that. Because it is a skill to like really, not saying you're being crafty, but you really build a relationship with the seller and create that space for buyer and seller. Like if they really hone in on wanting this property, how can you create a space for them to build a relationship and say, you know what, I'm gonna just go ahead and give you the 3,000 down. I'll take off what I'm asking, give you 3,000 or 4,000, and walk away with what they have.
Oh, absolutely. And again, we do teach those type of strategies and everything like that. And we'll even say, hey, listen, you're asking, $240 for this property. We'll offer you $245 if you're willing to give us $5,000, in cost back to the borrower. There's a lot of different ways.
This is a tax write-off.
Absolutely.
People don't know that, and that's what I know. When I go and buy my properties, I say, this is a tax write-off.
Mm-hmm.
You give me this $3,000, $4,000, $5,000, you actually can get it back at the end. And a lot of sellers don't know that.
Oh yeah, a lot of because again, their realtors aren't teaching them those type of things on the front end, for sure. Absolutely. Thank you for that. So like I said, it is like I said, if it's a necessity to use that type of program, I would recommend using it. Otherwise, again, I always recommend the ones that are not repayable, over a period of time. Any questions?
Do you make recommendations for the clients when they come in and look at their situation and say, hey, this is what you need, I recommend this, that, third?
Oh, absolutely. So that's the whole guise of the pre-approval process. So when you come to me, I'm going to look at your financial situation and say, all right, listen, these are the programs that you qualify for. This is the amount of money you have. This is what's going to cost you to close. We've got to find a way to bridge this gap here. If I see that your credit score is at a 660 or a 669 and the next interest rate tier is at a 680, I'm say, hey, if you do this, it's going to get your credit score up to X, Y, and Z, get you a little bit of a better interest rate. I'll definitely guide you in all those ways. And that's the whole premise of, again, the pre-approval process. The pre-approval process is making sure that you're financially sound so that when you're shopping out there with the realtor, that you have all your bases covered, and you're not guessing where your money is coming from. You're not guessing what your rate and stuff is going to be. You don't have any qualms about anything. You have a clear picture moving forward of what you're going to be able to do.
And versus the other companies, how do you rank for us competitive?
Competitive as far as interest rates concerned?
Interest rates or?
Well, I mean, we're
quality of service.
Quality of service. I mean, top tier. I mean, I wouldn't pit anybody over this. Interest rates are always going to be a different playing field. I mean, we're competitive in the market. We have some of the best rates that are out there. But some companies will undercut their rates because if you're not familiar with how the interest rate market is, they'll come in with, we always have a floor of what it actually costs us for that rate. And all lenders put their margin on top of that. So some companies will say, all right, well, the rate's 1.5. We're going to charge 2 points on top of that to make sure that we're making enough money. Some lenders are going to say, all right, well, let's cut our margins so we can, we'll make less money on the deal, but we'll beat this other lender out in cost. So it's really a crapshoot when you're dealing with lenders always recommend, even when you're dealing with me, get a competitive offer. Because if you get a competitive offer and you shop around, the lenders are going to bend a little bit. They're going to say, all right, well, yeah, I see they're offering you a 3.5, I'll offer you a 3.2. It's going to cost you maybe about a point, but it's going to be better here. There's always going to be a negotiation point with every mortgage company out there. Some of them just say no. They're like, no, we're not going to compete. If you want to work with us, you want to work with us. I'm going to tell you to send it to me anyway, because I want to give you the best deal possible. You know what I mean? Did that answer all your questions? Any other questions?
I have a question more so much as like a statement on that. So as we've already said, I'm 22. And I already established my credit, but when I established my credit, I was 18, and that was because I literally put $10 on my student loans. So I know that the majority of the people in here have already established credit, but I just figured that like if any of you guys knew anybody who needed to start establishing credit and already had student loans under their belt or something like that, that's a way that they can do that.
Awesome.
Yeah, sure.
Awesome.
That's what I did with one of my student loans. They try to tell you to pay a certain amount, but if you send a $5 check to your student loan, by law, you have to cash it, and that could be your student loan for every month. But they don't want you, that's the law. Whatever you send them in the check, they have to accept it as the loan you can pay back. But as I was taught, we lend you the money to go to school. Giving $5 a month does not allow us to lend the money back that you send to us to give to somebody else. So this is why you should do it. I think the strategy that you used was good, because if you pay your loan for 12 months straight, your interest rate goes down hot, it goes down a little low.
For sure.
And then a lot of people don't know, if you work in a environment for disadvantaged children or families, after a certain amount of years, you get your loan forgiven. But at least, I think it's 10 years, but if you work consistently, effectively in that sector and you're still paying your loan, then it boosts your credit score up.
For sure.
So.
And like I said, just having the student loan on there in general is going to boost your score. So it's going to report positive every month. The part where it comes in that it helps you. So I see a lot of student loans on credit reports that are, you'll see the starting balance is at $4,000 and the current balance is at like $10,000. So paying that $5 or $10 a month helps stave off that interest that you're going to be growing in the accruing.
I'm gonna just drop this gem on y'all. I was still in school when I did that, so I technically didn't have to pay my loans. I just dropped that $5, $10 on there just to make myself feel good, and it happened to establish my credit.
There you go. That's awesome. That's awesome. And what did you go to school with?
Drop that. So.
Listen, but you went.
I did. I was studying creative writing and theater.
Okay. Yeah, that's awesome. Listen. Life happens. Oh man. So that's the general guys getting pre-approval. Pre-approval, like I said, we're gonna go look at your credit, we're gonna look at your income, we're gonna look at your employment history, we're gonna look at your living history, all that stuff for the last 2 years. If you're looking to purchase, make sure you like I said, get your credit pulled by either a lender, go on annualcreditreport.com, get a free credit report, and if there are things on there that are reporting negatively and you want to make sure you address those things because they can't hold you up from buying a house. If you owe any federal debt, that will hold you up from buying a house. If you have any judgments or liens, that will hold you from buying a house.
You said that again. What was their website?
Annualcreditreport.com. They will give you a free copy of your credit report. They won't give you the score, but they'll give you the credit report and it will show you all of the items that are on your credit report. So if you see something that's not supposed to be there, you can dispute it with the credit bureau.
Can I give that the trick? It's called Kickoff.
Yep.
So Kickoff is really cool because I paid like $12. And what they do is you pay whatever you want to pay. But I did the minimum $12 just to see how it was going to work. And what they do is they report it to all 3 credit bureaus that I paid on time, but it was just $1 a month.
Yep.
Basically $1 a month.
Absolutely.
Right? And so that really helped my credit score a lot. And then it came back and said, hey, if you pay a different like you pay a different rate, we'll double your credit score. And so now I did that the second year, I literally went from like 5 something, because of all the stuff I went through, 5 something now, I'm at like the 690.
Yeah,
It's crazy, but the last 2 years.
absolutely.
Probably, and it was just $1 a month. But they don't tell the credit union it's $1. They just say, she
Yeah,
will put it on time.
yep, when
And
you
show
look,
you your credit score.
when you look at it on the credit report, it'll actually show as a revolving debt.
Yes.
It'll show that you have a $500 balance with that company,
Yeah.
and they'll show that you owe $20 on it, on that debt, but you're paying $1 a month and it's helping you build your credit. That is one of the tools that I tell everybody as well. If you're familiar, do you use self-lender?
No.
So self-lender is another one if you're looking to establish and build credit. Yep. So you start off with them, you pay $9 to start up. You pay them $48 a month, but that $48 a month goes into a savings account.
And you get the money back.
You get the money back after a year. Yep. So after you make all your on-time payments, each month when you make your payment, it reports to all 3 credit bureaus. And after you make all your on-time payments for that year, they'll send you a check back at the end of the year.
Yes.
Also, in the middle of that time period, they're going to offer you, after you make 3 on-time payments, they're going to offer you a secure credit card with the funds that you have saved making those payments every month. So if you've made $300 worth of payments, they're going to say, hey, we see that you're making your payments on time. Do you want to open up a secure credit card with us using your funds from self-lender to help build your credit even more? So now you have 2 credit references from the same money that's going to help you build more credit. But yeah, that's all.
The $48, so that's what you're paying on time.
Yeah, so you pay that $48 a time, and like I said, it's just a savings account for you. So you get 98% of that money back. They do take, I think it's like $50 at the end of the process there. But $48 a month, again, like I said, you just pay that on time, reports to all 3 credit bureaus, helps build your credit, and then at the end of it, they'll send you the check back for the 98% of what you paid it to.
But I also know the high, if you pay $48 a month, you're gonna have to do like 2 years of payment. But if you do higher, like say you pay like $100 or some dollars a month, it's lower in months in terms of the return. From that.
They have a year $48 option.
They do?
Mm-hmm. Yeah, they have a $48 option. They have a $100 option. And they have 12 and 24 months on both of those. So again, it's really on what you can afford and what you're looking to save, because again, it's twofold. You want to be able to save some money, because again, like I said, it is a credit building savings account. There's another one called Credit Strong. There's a bunch of different outlets out here. When we get finished with the seminar, I'm going to be, sorry, what was the question?
No, I didn't see the information in the folder. They kicked you out of the folder.
No, they didn't get in the folder. I kicked myself out of the folder, so my brother used my vehicle last evening to go grab groceries from the store and took my media box out of the car and put the groceries in and never put it back in. So when I got here today, I got surprised that I didn't have my box of literature for today. Needless to say, I was a little ticked, but as well.
You gave a couple messages about different grants that we can use to help you build kind of that.
Surely, so the grant programs are, like I said, the PHFA, again, that's considered a grant, because again, they're going to give you 5% of whatever your purchase price is. They used to have Philly First. I think I'm getting the Sandman, guys. I saw Mercedes look at me. She still got to have a little bit of talking here. But what I was saying before, if you guys all scan the QR code, get everybody your email. I'm going to be sending all my literature out via email to you guys. I will send those grants to you. I will send all the information as far as what the qualifications for them are as well. But again, grants are awesome. They vary per the time of year and everything like that. Because like I was just telling, like he was mentioning, some of them are only available in the beginning part of the year. So that is my time. I'm going to hand it over to Mercedes. I am going to be sending everybody a first-time homebuyer's guide that's going to explain a little more detail about the full process of home buying. You'll have my contact information. Feel free to give me a call. Use me as a resource. Even if you don't use me as a lender, always feel free to reach out and say, hey, I was looking to, buy. I am a nationwide lender, but I was looking to buy a property. I started working with somebody, and I'm not, comfortable with what they said to me. Always use me as a resource and ask any questions you have. All right.